All right, well, last week we looked at the CAPM model and how it came about, the crazy process that led to it being developed, and the way that was a distortion right from the outset of the axioms of expected utility that von Neumann developed, and also why the whole idea of maximising expected return isn't rational when you're working with a single one-off. It is when you do it 100 times, but that's not what happens in the stock market. This week we'll look at how the CAPM, which was originally used to justify, data was used to justify the CAPM, data finally destroys the CAPM. So the basic argument, of course, of the CAPM is that the market's efficient as economists define the word, which has got nothing to do with the English language meaning of the word. And if so, prices would follow a random walk where the deviations from trend would follow a random distribution. Of course, the normal distribution is the archetypal random distribution, where in any of those various distributions, Poisson or the normal itself or log normal and so on, the chance of a huge variation is vanishingly rare. Anything above 5 standard deviations you can pretty much rule out. Now the actual data shows that huge changes are extremely common, and we've been living through a couple of weeks that are just like that. So it's not efficient as economists mean. It might be efficient as people use the word normally to say things happen really quickly, but it certainly isn't efficient. And what's going on might actually involve what other traders believe. So the whole idea of the efficient market hypothesis is that traders simply focus on the incoming news, rationally reevaluate prices to be to reflect the new news that's come in, and that's what explains the movement. The real world might well be traders looking at what other traders are doing, both strategically and actually trying to get information about where the market might go, and the feedback between one set of traders' behaviour and another actually causes what we see, which has got huge nonlinearities, lots of booms and lots of busts. Now, that's the real world. CAPM, of course, became part of the efficient markets hypothesis, where the real world doesn't apply and everything happens in equilibrium. And it gave an explanation of why traders couldn't profit based on that whole idea that if the market's in equilibrium, there is no mispricing to exploit. So that then says you can't actually make a profit. Now it's quite possible to reach exactly the same conclusion, say it's really hard to make a profit, by saying the markets are actually chaotic. There's an incredibly complicated disequilibrium process going on. So there is something deterministic in the data, but and mispricing does exist at all times, but it's such a complicated pattern that it's really hard to work it out. So you can reach exactly the same result to say it's really hard to beat the market, with a quite opposite argument to say the market's in disequilibrium rather than saying it's in equilibrium. Now, a system that has these sorts of feedbacks won't be efficient in the way economists use the word, because fundamentally that word means close to equilibrium. Okay? The way economists define the word efficient is to say the system is either in equilibrium or very close to it. Now, it can still be very difficult to predict those systems, and therefore it's similar to the whole idea that you can't exploit mispricing. But what you've got is a system operating a long, long way from equilibrium. And the best example I can give you of that actually comes from meteorology. Now, you're all used to watching the weather programs on the news at night, watching those fantastic patterns behind the person presenting the news. Clouds moving in, predictions, etc., etc. It all emanated in work by a mathematician stroke meteorologist called Lorenz back in the mid-60s. And he tried to model a fundamental idea of how turbulence occurs in the weather by saying that what you've got with a weather system is like hot water on a stove in a pot, where the turbulence is caused by heat. And then you get a turbulence in the fluid. Same thing applies in the air. So there's convection going on, and that'll be rising and falling cells of water. If you look in a pot you've got on the stove and see the bubbles coming out of it, you'll see there's actually patterns going on there, circulation patterns as water gets hot down the bottom, rises to the top, cools and falls back down again. Now, that is exactly the same process is occurring right beneath your feet. It had a bit of an exciting twist today when it occurred almost beneath the feet of the American Washington State, about 20 or so kilometres away. There was an earthquake there. The cause of all that turbulence, the cause of the movements of the plates that gives us an earthquake, is the movement of the magma. that lies beneath the surface of the planet. So you're standing on a sphere which is about 6,000 to 7,000 kilometres in diameter, most of which is liquid. And the heat coming in from the core of that, and this is like doing a Mercator projection of the entire planet. So down the bottom here we've got the core, the core of nickel iron at the heart of the system of our planet that generates all the heat. And then magma will be heated and rise in a current from the bottom up to the top, and that causes both volcanoes and the spreading of tectonic plates and earthquakes. When it gets to the top it cools and it falls back down again. So that's one of the many illustrations you can get of this sort of process occurring all the time. Now, when the column starts to cool at the top, the distance between the rising and falling column will be quite close. Down the bottom it'll be much wider apart as it falls back down again. So you get this shape of the cells. And Lorenz built a simple mathematical model of this. It was actually derived from models of fluid dynamics that have been around for about 2 centuries. And it has just 3 variables in it and 3 parameters. So it's an incredibly simple system. And those 3 parts are the intensity of convection, so how fast are those cells turning over, the gap between the rising and falling current, and of course you're taking an approximation to give a single value for that, and then how much that differs from a linear profile, how much the variation isn't a straight line from the top to the bottom, the heat difference. So putting that back in that same map again, what you've got are these 3 equations, dx dt, where x is the convection, so that's how much the convection intensity is changing with time, the change in the temperature gap and the change in the deviation of that profile from a linear profile. So those are all rates of change there. You're used to doing differential work where you differentiate price with respect to quantity and things like that. This is not the same thing. It's differentiating a function with respect to time, and that's a differential equation. And so you map that over there. There's the dx dt for the intensity of convection, dy dt for the gap between the rising and falling currents, and dz dt for how much that profile, the temperature change, is non-linear. Now, it looks pretty simple, and an economist who might approach that would say, well, there's only 3 equations and 3 parameters. Should be pretty easy to work out an equilibrium. End of story.
These are simultaneous equations, right? These are simultaneous equations.
No, differential.
They are simultaneous differential equations, isn't it? Like in the sense that the x, y, and z all are varying with time.
Yeah, I'd say they're coupled differential equations, not simultaneous. The simultaneous equations are things which, you want to find a single value of the 3 parameters of which all 3 are equal, which is a different story to this. So the expression you use is a set of coupled differential equations, because as you can see, x depends upon y and z, y depends upon x, y, and z, and z also depends upon the x, y, and z values. So they're coupled to each other. One variable determines the other as well as itself. And what you've got is a semi-quadratic. If you look here, you've got x times y and z times x, which is a bit like y equals x squared. Well, so the first step, work out the equilibrium, which is the typical thing an economist might do. And to do that, what you've got to do is set all those rates of change to 0. So you want to find where the temperature, gradient, the etc. equals 0. And I've got a good shaking head over in the corner there for good reason. Well, you solve for x, y, and z. Let's go through and doing it. And start with the first equation. And obviously, if y equals x, that equation is equal to 0. So y is equal to x is one of the solutions. Put that in the second equation, say x is equal to y, so you can substitute where you have x, you can put in y. And by doing that, you get b minus z multiplied by y equals y. So you can conclude from that that z is going to be equal to b minus 1. So you've got a value now in parameter terms for z alone. Feed those both into the third equation. So you substitute x, where you see x you put in a y, and where you see z you put in b minus 1. And now what you've got is a quadratic. You've got y squared is equal to c times b minus 1. So that's going to have 2 solutions, the positive and the negative square root of y. Or square root of y squared, pardon me. So you're going to get those 2 expressions coming out. And of course that means you've got the same solution for x, because x is equal to y. So where y is the positive square root of c times b minus 1, x will also be that same positive square root. And thirdly, there's another solution again. If you notice the equations, if you put in z equals y equals x equals 0, you also get no change in the variables. So, oh dear, rather than having only one equation, and with 3 equations and 1 solution, you've got 3 equations and 3 solutions. That's one, and there are the other 2. What a bummer. But, you know, economists might think, well, that's okay, one of them must be stable. Let's work out which one is stable. Well, I could drag you through the mathematics of all this, but I'll just give you the answer. For some values of the parameters, all 3 equilibria are unstable. Now, that might mean an economist, throw up your hands in horror, you can't do anything. No, that's not true. You can work out how it's going to behave by simulating it, because there's many, many systems in the real world which are always unstable. And engineers that have to cope with this sort of stuff have developed a whole range of programs to help themselves manage simulating, see how they're going to behave in a real world situation. Now, the basic idea is you represent the system as either a flow chart or a set of equations, and you then feed in an initial value and iterate that forward through time and approximate and see what's actually happening. So to show you what happens with the Lorenz system, there's the Lorenz system. Now, when Lorenz first did this, it was back I think in 1967 or 65, and of course computers back then were trivial compared to what we've got these days. Your calculator, if you have calculators, is likely to be as powerful as the computer that Lorenz simulated the system on. And it also had a little quirk to it. It worked internally at 6 decimal places of accuracy. Your computers work at 17. Much, much higher level of accuracy. But it had a printout that worked at 4 digits. So he got the first result and got this really complicated pattern, and then told his research assistant to feed back in the initial value, just to see if there was a mistake. So the assistant typed in the 4 digits that the printer had, not the 6 digits that Lorenz began with, and they got a completely different pattern. So that little insight, which is an accident, was a real start of working out what chaos is all about. But if you simulate the system, these are the x and the z values, and you'll see that the z value, which is b in equilibrium is b minus 1, is actually all over the place, okay, up and down like crazy. And you'll notice the x value bounces between positive and negative values of that expression, going straight through the middle, which is where the 0 value is. Now, would you say that's can you see any pattern to the patterns? Can you spot anything that might give you a bit more structure than you can see there, or is it just too damn complicated?
The mean is 0.
Pardon?
The mean seems to be 0.
The mean is 0, but are you ever in the 0? Because that's what's actually being drawn. If I now stop that and re-simulate it, I'm now simulating the x value against the y value. Remember, in equilibrium, they're equal to each other, or 0. And what you get is the system is forever orbiting one of the equilibria or the other, passing around near the other one, but never going anywhere near the actual equilibria. So rather than the equilibrium telling you where things are going to happen, it tells you where the system is never going to be. So the economist practice is saying, let's work out the equilibrium, and that tells us what's going to happen. No way. You work out where that is, the weather's never going to be there. So the basic idea of how these systems actually work, that software I'm showing you running in the background now, is that you take a variable like, for example, population. This is a very simple equation. You multiply that current level of population by its growth rate at a moment in time, integrate the flow of extra babies that cells you're going to have, and add that to the current population, and add that again to the initial population, and you get an estimate of the future population. So just showing that there's another flowchart program, same program, different situation being simulated, where I've got the population for Australia in 2009, I'm feeding in its growth rate, and I'm trying to predict the future population. So there's population, that's what I'm trying to work out over time. I multiply that by the growth rate, which at the time was 1.5%. I integrate that, add it to the population that existed in 2009, and I've got my new estimate for population, which is then smoothly predicted over time in a series of iterations. And that says that if we had maintained the population growth rate back in 2009 by roughly 2,110, we'd have about 100 million Australians, which I don't think is going to happen. But that's another story. And I've embedded these simulations in the presentation, and I've got a version of the program you can download from the website and run it yourself if you like to give it a try back at home to see how this stuff works. You can't edit the stuff, but you can actually download that zip file that just passed across on the screen there and play with the programs and see what happens. Actually, with that version, you can actually build your own models if you want to. That's a version I'm allowed to distribute as a user of the program. So that's what the model looks like. Pretty complicated. I think the equations are actually easier to read in that particular situation. And of course, when you simulate it, you get that pattern I showed you a moment ago. So it's never an equilibrium, and it follows patterns that are unpredictable. That was the point of that illustration. When Lorenz's assistant typed back in a set of numbers that differed by only two decimal places, 5 and 6 decimal places, so 0.0000XX, that difference for the original, after a very short time period, the simulation pattern that came out was entirely different. And also the cycles that occur are aperiodic. When you talk about sine and cosine, you get a set sequence. If you go from one time period, one peak to the next peak, it'll be 2 pi units of time apart. These are always different. The gap between those will differ each time, and of course the value differs every time. Even though these look similar to each other, none of those peaks are the same height, and they never will be. Do it for an infinite number of periods of time, you'll never get the same value recurring. But there's a hidden structure, as I showed you, that gorgeous, what people call the butterfly effect, looks like a mask or a butterfly's wings, is the pattern that the system is actually running in behind the scenes, where it produces what looks like, at first glance, chaos, which is what this whole field was called chaos theory rather than complexity theory when it first turned up. Now, drastically expanded and put into models which actually simulate the Earth's atmosphere in 100 metre by cubes of air, which now also include chemical actions taking place over the surface of cities and all sorts of other complications. That's where you now can model the weather. So the patterns you see, which are simulated on the computer screen, are actually very elaborate versions, extensions of what Lorenz did here. And the basic concept again is you've got this idea of heat at the surface causing air to rise and then falling again, and the same sort of structure I showed you when the magma applies in that particular fluid. Now, can that turbulence explain what happens in stock markets? Well, Benoit Mandelbrot, who died recently unfortunately, thought so, and he actually wrote a paper on this effect back in the early 60s. I think it actually predated both Sharp's paper and Fammer's work to support the efficient markets hypothesis. So economics could have grabbed hold of a much more realistic idea 50 years ago. Now, they ignored Mandelbrot, and what he did instead was go into geography, where he invented the idea of fractals and applied that to landscapes, and I'll show you a bit about that later. But having ignored him, we instead this argument that they were efficient, reflecting all available information, all this sort of stuff. Then, of course, they'd follow this random walk. So that vision, which is quite different to what I'm talking about here, is what took over economics. And that should mean, if it's true, that you get a Gaussian pattern. I'm Gaussian inverted commas because there's more than just one random distribution, but I'm going to use the normal as my guide here to say what the market should be like if the CAPM was actually accurate. So what you should get is something like you get when you toss a coin or you roll the dice or you spin a roulette wheel. In the limit, you're going to get something which fits the normal distribution, where you can describe the whole thing by the mean and the standard deviation. And you can also say that, given that information, 68% of changes are going to be within 1%, 95% within 2%, and rapidly dropping off towards 0 as you move further and further away from the mean. Now, just apply that to something where it does actually apply. The average height of American males is 178 centimetres, and the standard deviation is 8 centimetres. And there's roughly 150 million of them, so the height distribution should look something like that. You get very, very few who are less than 160 centimetres tall, very, very few taller than 2 metres, and the vast majority in the middle there. And if you rank them from the shortest to the tallest, you get something like that. So down the bottom, very, very few less than 160 centimetres tall, equally very, very few taller than 2 metres, and then everybody else in the middle. Now you can ignore anybody who's taller than 2 metres. You can almost be certain they're playing American basketball. Okay? You can ignore them in terms of working out the average. If you knocked off if every basketballer on the planet got wiped out by an earthquake, it would have almost no impact on the average height of Americans. Equally, if everybody less than 160 centimetres suffered some calamity, that also wouldn't vary the average height of Americans any significant way. So those extremes are such a trivial part of the overall system that you can leave them out. You can treat them as outliers, whether you work in standard deviations or actual height. Well, that same thing would apply for the stock market. You say, give me the average movement, give me the standard deviation, and 68% of movements will be plus or minus 1, 95 will be plus or minus 2, and a trivial number of greater than 5, and therefore you can ignore those extreme movements. So the average, if you actually do your stats across that time period, you get an average of 0.02% movement per day. That's the drift component going upwards over time, and a standard deviation of 1.136. And I've now extended the data a bit to go to 2011, but there were 24,500 trading days until roughly the same time 2 years ago. And the market therefore should look like this. That's saying, let's take the range of dates we know, feed in a random distribution, see what it generates as a random number system. That's what the data should look like. It actually looks like this. You should show that to your other lecturers and say, would you like to knock off the outliers now? Now you sort them from the smallest movement to the biggest movement. The random distribution gives you something that looks like this, and looks just the same as the pattern for the height of the average American. Now, what about the actual data? At first glance, just looking at the chart like that, there's not much difference. But you've got many more events near the average, and there's a large tail, but it's not obvious straight away how large that tail is. So I'm just looking from -6 to +6 standard deviations, which, according to a random distribution, would be the entire range you'd need to look at, because there'd be nothing really outside that range. So there's a bit of it looks a bit different. But how much longer is that tail? What I'm going to do now is reproduce the same chart, but I'm not going to chop it off at -6 and +6 percentage movements. I'm going to go out as far as the actual data does, and use the log of the percentage scale as well. And that's what I get. Okay, the horizontal axis is the actual percentage movement on a daily basis, and the vertical axis is the number of trading days that had a movement of that scale or greater than that scale. And what you get with the Dow Jones, with the simulated data, it's telling you that nothing is going to give, you're going to get absolutely nothing, which is greater than that actually ends at about the 4% scale there. You can't quite see the blue overwrites the red, but nothing is going to happen past there, nor are you going to get any bigger positive movement than 5%. But if you take a look at it, there was one day, way out here, where there was a 22.6% fall in the market in one day, and way over here there was a 15% increase. So all that data there and all that data there isn't supposed to be there according to the efficient markets hypothesis. So you've got movements as large as -22% in one direction, as big as 15% in the other. The data is not Gaussian. It's not something you can model using a Gaussian process. So what's actually going on? Because it's obvious now that the simulated data is nothing like the actual data. So what does it mean? Well, the same number of data points, and the random walk gives you a much narrower prediction of what's going to happen. That's now looking at the other end, percentage daily movement versus trading movements with days with a bigger movement. So the random walk has to be shorter than the actual data plot, and that's what you see. That's the entire range that the random distribution says you're going to get. That's the actual data range. And the random says you're only going to get one movement of more than 4.46% or greater. That's its prediction there. Go over this side, it says there'll be one trading day like that over roughly a century. How many were there? Go up and check the data. There are actually 100 such days. Being wrong by a factor of 100 is a pretty big mistake. So you've got a drastic underestimation of the degree of volatility in the market. This is now looking at the worst 20 falls on a daily basis in the Dow Jones since 1914 versus what a random prediction will give you. And I know it's hard to read the numbers there, so I'll just give you an idea. The worst was October 1987, when the market fell 22.61% in one day. I go down to the 20th of that list, roughly, and I find that I've got a minus 6.9% movement in one day. That's number 20 in the greatest hits of all time for the Dow Jones. The random prediction says that the worst you're going to get is minus 4.46. It doesn't even rate compared to the worst 20. In fact, it doesn't rate compared to the worst 100. Okay. Now, also what you get is an incredible degree of clustering. There are all the events from the 1930s, and you can see how many of those worst events occurred in the 1930s. Wait for it, the 2010s are going to, I think, get pretty equal billing in a while. If you look over at the other distribution, they're evenly dispersed through time. So you have 1917, 1930, 94, 41, 73, 56, 17, 24, 87, 79. That's the first top 8 or so. No pattern. So there's a much higher scale of movement, and there's a pattern, there's clustering in the actual data. So you get this argument that you can't predict things using the CAPM, whereas there are plenty of theories now to cope with what's actually happening in the market, and they say that there's a non-random structure to it. There's something going on, some deterministic stresses, as well as noise behind what's happening there, noise and news. And given that process, what you're going to get is many more events occurring in the extremes. They talk about being fat tail distributions. And extreme events of any magnitude are possible, whereas they're vanishingly unlikely for the random distribution. So, for example, if you look at the random distribution prediction and say, what are the odds, if that was actually the process, what are the odds of a 5% fall? Less than 2 in a million. You'd need to wait 500,000 trading days to get one event where there's a 5% fall. In fact, you'd need to wait 2,500 years to get one fall like that. Take a look how many there were, you get hundreds. Now, the distribution I'll be showing you a bit this today and a bit next week is called the power law. And that's something which is actually worked out in the first wave by a guy who was actually famous in economics called Pareto. Heard of him? You, if you have, okay. He did some sensible stuff before he invented Pareto optimality. And one of them was to look at the relationship between the size of cities and the number of cities and their size, number of words in the language and how often they're used and so on. And he said the number of events of a particular size, like people earning more than 90% of earning more than, say, $1 million a year, is something, that number raised to some power. So the basic expression, he said, another sort of probability distribution, but the probability of an event greater than X was going to be equal to 1 raised to the power of minus some power. Now, what you get out of that, when you then analyse it, you take the logs of both sides of that equation, you get a straight line, because what you're saying is, I'm leaving out the intercept here, the log of the number of events of scale X is going to be roughly equal to minus alpha times the log of X itself. Now, that doesn't sound like much, but it has a dramatic impact on how often you can expect extreme events to apply, and it applies to a huge range of events. Earthquakes, for example, are one it applies to. Size of cyclones, income distribution, usage of words in the English language, all these sorts of things. So, does it apply to stock markets? Let's take a look. Now, I've done a bit of calculation to say that a coefficient for the Dow Jones appears to be minus 3.96, which is quite a large number as these go. And that's the slope of the line you can see there. Whereas the dotted blue line are the actual value for the number of movements greater than a certain percentage. So to read that chart, down the bottom, minus 1 means 10 to the minus 1, or a 10% change in a single day. Over on the left, on the vertical axis, 1 means 10 to the 1, or 10 events like that per century. So the question is, how many, what does the power law predict of the number of 10% movements there'd be in a century? And the answer it gives me is there's going to be roughly 6 such events. How many were there? 8. Pretty damn close. Now let's compare that to the sort of prediction you get from a Gaussian idea, where you say the probability distribution is actually a Gaussian or a random distribution. What does that predict? Well, this is exactly the same chart, but now I'm including in, and I've got to change the vertical axis somewhat, the predictions from a normal distribution. And you can see how the normal distribution says you're going to get a vanishingly rare number of events of any large scale. Now it's okay for small ranges. If you look at how many events had a 3% scale movement, it's saying there'll be roughly 780. There in fact are 718, which isn't bad. So if you chop off the distribution, getting rid of outliers, which is standard practice for a lot of statisticians, unfortunately, it's valid to do that when you've got things like you're doing an experiment involving mixing of some chemical and somebody runs a truck into the mixer. Okay, and you get a huge jolt in your measurement. You knock that out as an outlier. It doesn't work when you're looking at a process which is, as I'll explain later, self-referential, where the market's behaviour depends upon the market's previous value. So it's hopeless, the random distribution is hopeless when you look at large changes. If you look at a plus or minus 6% movement, there's 57 is the actual number versus 1 predicted by the theory. And if you look at, say, the theory being that it's Gaussian, if you take a look at a plus or minus 8% movement, there are 11 such movements in the previous century, whereas according to a random distribution, there would be 1 every million centuries of that scale. That's pretty wrong. Let's take a look at that again. Minus 1.2 here means a 10 to the minus 1.2 or a 6% change. And the Gaussian prediction is 1 event like that, 10 to the minus 2, every 100 centuries. Yeah. You'd be reading historical annals of it if that actually had happened, if that were the way things actually happened. The actual number is 57. Pop up here, there's your vertical scale, and you can see how accurate the power law was to that actual number. 10 to the minus 1.1, an 8% change, 10 to the minus 6, once every million centuries. Take a look at the actual number, there are 11, which is spot on the prediction from the power law. So that's how much more accurate the power law distribution is looking at the stock market than the efficient markets hypothesis. But those people who believe it have a belief in equilibrium and that change is due to random shocks, and therefore huge movements are vanishingly rare because you need a whole number of random shocks all in the same direction at the same time to give yourself anything really, really big. Now the actual data is manifestly different to that, so I want to again give you a few comparisons of just how different it is, therefore how misleading it is to apply anything with that idea that random change is what's giving you the distribution. Now looking here, I'm looking at the daily movements in the stock exchange, and if you look up here, it's saying how many events were in the range of plus or minus 1%. The actual number of events over that period of time is 17,800. The Gaussian prediction, there'll be 18,600. So the ratio between the two is pretty close. Ditto for anything between plus or minus 2%. 3,800 such movements. Gaussian prediction 3,500 roughly. 1.1 ratio. 3%, again, pretty good. 780 actual events, 719 predicted. 1.09 is the ratio between the random and the actual data. But when you get to 4, there are 257 events bigger than that versus 67 from the Gaussian, so it's wrong by a factor of 4. Look at a 5% movement, 106, versus just about 3 predictions over the century, 38 times wrong. You get to the big stuff, a 6% movement, 57 such movements, once every, 0.05, once every 20 centuries, 1,000 times wrong. 7% movement, 53,000 times wrong. 8% movement, 7 million times wrong. 9% movement, 1 trillion times wrong in the scale. Out here, you get to 10%. The Gaussian prediction of how many events would be like that over a century is 0 to 20 decimal places and more. So it really massively distorts the actual size of a huge event. And huge events are far more likely in the actual data and according to a power law prediction than you get from a efficient markets hypothesis point of view. So crashes in the market are not aberrations. They are its normal behaviour. You're put in an extremely normal version of normal right now. So let's take a look at another way. here's graphing the actual versus the predicted for the daily changes in the stock market. And again, when you look between plus or minus 3, which is this range here, you're pretty okay. The actual data versus the predicted are pretty close to each other. When you get out here, the actual data versus the prediction, enormously different. And in fact, you get, if I go out to here, the prediction is nothing, 0, 0, 0, 0, 0, actual number 13. For really big negative movements greater than 7%. Positive movements, greater than 7% movement, 7 such events, prediction 0.0004 such events. They're slightly higher because there's a positive bias to the data, that so-called drift. Looking at it another way, is now ranking the actual data versus the predicted once more and saying how many events do you get which are greater than 1% movement. Notice there's a big peak to the actual data compared to the Gaussian. The Gaussian is very chunky here because I'm taking in frequency bins rather than smoothly. That's a common characteristic again of these distributions. You can't really tell just how much bigger that tail is than the actual random distribution prediction because it's such a compressed area. So I can actually show that another way. And that's saying what's the ratio of the actual number of events predicted by that actually occurred to the prediction from the Gaussian. And when you get out to 7% daily movement downwards, the difference between the actual number of events and the Gaussian prediction is 10 million. Up the other end, greater than 7% movement in a day, the number of movements of that scale is about 50,000 times higher than the Gaussian prediction is. So that ain't random, and it's something that you have to look at in a much more sophisticated way than the simplistic efficient markets hypothesis. So, pardon me, what you get is that there's a partly deterministic process behind what's happening. You don't get a fractal pattern unless something causal is happening in the sense of one variable in the system affecting another variable, as I showed you with the Lorenz system. And it's also highly nonlinear. A tiny variation in the degree of interaction has a huge impact on how much change there is. So you can imagine in the stock market it'd be interacting battles between bulls and bears, and believe me, they do fight each other with all sorts of tactics. One of the favourites that being used right now is what they call a short squeeze. And feedback between the financial system and the economy, because one thing which comes out of this, once you have the efficient market hypothesis being thrown in the trash can where it belongs, you therefore can't argue anymore that finance doesn't affect the economy or vice versa. If you think about your finance courses, they don't have any macroeconomics in them. If you think about your macro courses, there's no finance in them. That's because, according to the efficient markets hypothesis, how a firm funds its behaviour doesn't have any effect on its value. So you can ignore debt when you look at the value of the firm, and you can ignore finance when you look at macroeconomics. Both those go out the window. So we need a theory of nonlinear, non-equilibrium finance and a theory of endogenous money in the macro, which I'll get into more later. But one of the curious things is, given what I've shown you today, why on earth do economists still cling to the efficient markets hypothesis? And I'll talk about that in the next half of the lecture.